I met everyone in there before. But what I'll do is I'll go briefly about myself, just for 30 seconds or so. This is the third one of these business bulletins I've done for Paul since we've gone online, as opposed to face-to-face. The first one was about the government's Corona Business Interruption Loan Scheme, CBILS, as it's called. The second one was a bit of an update on that, and this third one is, well, it's a bit of a refresh on what's happened, but also the big event yesterday, which is the launch of the government's bounce back loan scheme. So I'll be going through that as well. I've been in this industry pretty much my whole working life, about 17 years. I've been self-employed running my own commercial finance brokerage, JB Commercial Finance, for the last 5 years next month. And previous to that, I was a relationship manager, a corporate manager for Lloyds Bank. So I sort of sat on both sides of the fence, if you like. So I try and be as sympathetic towards the banks as I can about the systems that they're trying to implement, while also being critical, because we all love being critical of banks, don't we? So that's a bit about me and my experience, and hopefully you've seen a few of my videos and posts, and I've been out and about networking and stuff with our Paul's meetings over the last 6 weeks or so, and trying to sort of help out people where I can. So hopefully this will make some sense, and hopefully it'll bring some clarity onto some of the schemes that are currently available. So the CBILS loan scheme, the Corona Business Interruption Loan Scheme, was part of the Chancellor's big £330 billion financial boost that was announced in the middle of March. It was launched on the 23rd of March, pretty much immediately after it was actually announced. And it came out at the same time as the announcement about the furloughing of staff and the grants, etc., etc. So it was an important part of that stimulus process. We've got some figures now a few weeks in, and I'm going to just go a little bit about what that scheme was actually designed to do. And it was designed to sort of help the banks put the liquidity back into the financial system that have been that would have dried up. Because if a lot of businesses not viable at this moment in time, because they're not trading, it'd be very difficult for banks to service their due diligence with regard to getting money out there, because businesses couldn't afford to repay it. So this scheme came in. It was an 80% guarantee for the lender by the government. So if the loan fell over, 80% of it was paid to the lender by the government. There were 40 lenders originally accredited, including all the high street banks. And it was for businesses up to 45 million turnover, maximum loan size of 5 million. So very much aimed at the SME marketplace. And there'd be no personal guarantees on the loan, and the interest and capital were paid for the first year by the government with a further 5-year term as a maximum. So all sounds great on paper. As always with these things, there were tweaks along the way. The personal guarantee thing was a tweak later on. But as it stands, we've got some good stats behind it, so we know if this has been a success or not, really, but certainly initially. And the stats I'm about to announce, but for the end of April, and 4.2 billion quid's been lent under this scheme so far, and that's just over 25,000 successful applications, with an average value of 165 grand. So those figures sound impressive, 4.2 billion. Actually, 25,000 applications successful sounds remarkably low to me. We know that the actual formal applications figure is around about the 70,000 mark. But what that doesn't take into consideration is the amount of businesses who actually have made inquiries about the scheme and haven't even made it to application. And all the research suggests that's around about 400,000 to 500,000. So the actual success rate has been very low, in truth. Now, there have been some good things that have happened with regard to this scheme. So 4 billion quid's got out there. There's now 52 accredited lenders. And I think that's really going to help this scheme. And I've been bashing on for the last couple of weeks about the funding circle have been added to the panel, and guys like me deal directly with them. And I think that's going to make a big difference. I think other lenders will come on board to the CBILS panel. And I think it will, taking the pressure off the banks, will allow them to focus more, allow them to put more detail into applications. And will also allow more applications to be approved by alternative lenders. So I think there's a lot of scope for that scheme to improve. But the problems with that scheme and the criticism of it have led to the launch of the government bounce back loan scheme, which was announced last Monday and then launched yesterday. So amazingly quick turnaround for anything in the banking system, to be honest. And I have on very good authority that banks weren't actually consulted about this before it was launched. So God bless them. They were put on the hot seat and had a few emergency board meetings on Monday night about how the hell they're actually going to do this. So the differences between the bounce back loan and the Corona business loan, I'll go through in a second. A lot of things are the same. And what they've tried to do with this loan scheme is take the things that were working, or the things that were attractive and popular about the civil scheme, and apply them to the bounce back loan. And the things which maybe weren't quite working, try and amend that. So the things that are the same, you can apply up to 25% of your annual turnover. That's the same as the civil scheme. But the difference in the bounce back loan scheme is it's a maximum of £50,000. So it's very much tailored at the small end of the SME marketplace. Now, thinking about it, if you can apply for 25% of your turnover and a maximum of 50, then £200,000 is the kind of sweet spot turnover-wise for businesses this is actually trying to appeal to. So it's very much the small end of the marketplace. What this has meant is that the civils loan scheme now is exclusively looking at £50,000 plus. So the main differentiator between the two is that the bounce back loan scheme goes up to 50 grand, 50 grand plus is civil scheme, and you can only have one at a time. Incredibly important that. There's no point in applying for a bounce back loan now, and then a month later realising you've run out of money and trying to apply for the civil scheme. The answer will be no, unless that rule changes, of course. There's no personal guarantees in place on the bounce back loan. So again, it's exactly the same, but, and this is very important, the borrower remains 100% liable for the debt. So in the case of limited companies, which most of us probably trade as, and certainly a majority of businesses applying will be trading as limited companies, the company is still liable for the debt, but not the director behind the company. Okay, so again, important to remember that. The first year of interest and capital is covered by the government, again, similar to the civil scheme. The big differences, though, really are the cost of it and the application process. And that's where the amendments have been made to try and make this a lot more attractive to the SME marketplace. So the application process. A lot of people have criticised the civil scheme for the fact that it's taking sometimes on occasion 3-4 weeks for banks to get back to clients because of sheer workload. This is very much an automated process. The Chancellor announced it will be a simple two-page form to complete. Having seen, I think I've seen 3 of the bank's application processes so far, I don't even think it's that complicated. Certainly the one I filled in for myself probably took me about 2 or 3 minutes. Now, even allowing for the fact that I deal with forms all the time, I can't see what I dealt with the HSBC was more than 5 minutes. So it's a very, very quick process to apply. And the other thing which is attractive is the interest rate involved. The minimum term is, I'll handle the questions at the end if that's okay, Paul.
Yeah.
So, yes, it's the interest rate. So the civils loan scheme, the interest rates are set by the bank, and that can vary wildly. And I've heard some good stories about loans at 3.5% interest, and I've heard some horror stories where they've gone to 17, 18, 20% interest. The Chancellor announced last week that there would be a fixed interest rate with regard to this particular scheme of 2.5%. And like the civil scheme, there were no setup charges to get it established, and there's no setup and there's no charges at all to complete it either. Hello, Margot.
Hello.
So if you want to pay the loan off early, there's no repayment penalties involved, and there's no arrangement fees for setting the loan up, which should normally be 1.5% with a standard bank loan. So very attractive. But the 2.5% interest came out of the blue for us guys, to be perfectly honest. It was announced last week, and it is extraordinary cheap money, bearing in mind the circumstances. So they're the main differences. The only other real thing is that I think there's only 8 accredited lenders at this moment in time on the scheme. I checked last night, it may be more now. We expect more to be added to it. It's effectively the high street banks at this moment in time, plus a couple of others like Ulster Bank. It will go up. We expect people like TSB to be added quite soon, Starling Bank to be added quite soon. The Funding Circle are also trying to be added quite soon. And I expect that to go up to around about the 20 mark. It won't be as many as CBILS because the CBILS loan is a bit more flexible. There's other facilities that can be offered other than just a standard loan. So that was the big story yesterday. And we have some initial figures on how many actually have claimed. The figures are quite extraordinary, really. I mean, 110,000 businesses applied yesterday for the bounce back loan. Now, bearing in mind that on the civils loan scheme, only 25,000 applications have been successful so far, and they're claiming that the acceptance rate there is around about 40%. So according to these statistics that have been produced, more people applied yesterday for the bounce back loan than have formally applied for the civils loan since it actually was launched 6 weeks ago. So extraordinarily high numbers. The banks have given us some rough figures as to how many applied through them, but they all seem to report at different times of the day for some reason. I mean, Lloyds tell us that they've received 17,000 applications by midday. RBS had 22,000 by 2:30, and HSBC had 34,500 by the close of business. Barclays won't give any figures on the amount of applications they've had, but they can say they've made 6,000 approvals worth 200 million, which is quite good. 6,000 approvals, 200 million, yeah. So working on those figures, it's fair to say that all the banks have probably had around about 25 to 30,000 applications each, which kind of fits in with the figures as well. So an awful lot of people have been making applications. A lot of the websites have been crashing. We know Santander went down for most of the day. We know that Lloyds have had some trouble with their websites as well. And all of them have used the application process slightly differently. Barclays giving straight approvals. And NatWest, as I've answered a couple of questions about quite a few, seem to be fobbing everyone off for a couple of days and seem to be treating everyone to an email response saying, we're going to email you a form, and then not sending it, or in some cases sending it quite late, as I was found out this morning. But it's everyone who's dealt with NatWest that I've spoken to, which is really about 8-10 people, have had exactly the same experience. So I think the key thing is to be patient if you have applied, because this is brand new territory for the banks. The average loan size is £30,000, and the support that's been applied for is around about 3.3 billion on day one. So again, using the figures of 4.2 billion under Sybil's that's been launched, almost as much as that was actually applied for on day one of the bounce back loan scheme. So extraordinary numbers, they really are. One of the big questions I was asked yesterday is, if you don't have an account with one of the high street banks, how do you apply? Because RBS, Barclays and Lloyds have all announced that they will only consider applications from existing customers. They're going to put their own customers first and look at them. So if you have an account with Starling Bank, Tide Bank, TSB, what do? Well, you can wait for your bank to come onto the panel, which hopefully will happen. The only one of the high street banks who look as though they're going to accept applications at the moment from outside their own client base is HSBC, who having looked at theirs, they do actively have a box to tick to say, I don't have an existing relationship. So if you're desperate to apply, that will be a good starting point. Or wait for someone like the Funding Circle, etc., to come on board, which will in the next couple of weeks. So again, it's about being patient with this scheme, because the undertaking was just so big. So 24 hours on, I think it's a reasonably positive start. I mean, the fact that hundreds of millions of quid's already been sloshed out there is great. I have massive concerns about the due diligence that's actually been done by the banks, because I can't see how they're doing anything more than a very, very basic experience search. And you get to self-certify your turnover, self-certify your business. And to me, that's creating potentially a lot of problems, because people can and will inevitably lie about what they do. And it's important to remember that, yes, this is interest and capital repayment covered for the first year, but after that time, you do have to start paying the thing back. And so it's important to remember that. But so far, it's been good. All the banks are making tweaks to their systems to make sure that they're able to keep up with increased demand. Realistically, we're going to have to wait until the end of this week to get some proper hard facts, because everyone's got their own process. As mentioned, NatWest are effectively buying themselves 24 hours. HSBC are doing the same a little bit. And so once we've seen those figures, we'll be able to see the acceptance rates, we'll be able to see how much money's been sloshed out there, and most importantly, we'll be able to see the percentage of acceptances that have actually been done against the applications. And hopefully then we'll start to see some figures, start to see some money sloshing around the system and getting some bills paid. So that's pretty much all I wanted to do, talk about the bounce back loan. The application process is by your own banks. All the banks' websites have checked out. They've all got pretty clear gateways to actually apply. And that's pretty much it. So if anyone's got any questions, I know there's a few popped up in there. I'll leave Paul to sort of ask them if that's okay. If anyone's got any questions, please ask them now, or stick them in the chat room.
Okay, so I'm not sure that you covered it, James. Apologies if you did. So if someone applied for a CBIL loan and that was refused, would they be able to apply for the bounce back loan, or would the same criteria apply?
Yes. No, they'll be able to apply for the bounce back loan, and in fairness, that's where a lot of the applications are expected to come from. People being rejected for CBILs will now apply for the bounce back loan scheme. So that's an alarm going off. Bear with me a second. Not mine. One of my boys set an alarm on the stopwatch. I don't know how he did it, and we can't turn it off for some reason. I don't know why. So yes, you can apply. But if you've taken a CBILS loan out and it's under £50,000, you can still transfer it onto a bounce back loan if you want. But if you've taken one over £50,000, then you can't now apply for a CBILS loan.
Okay, makes sense. Okay. Darren, I think your question was answered, wasn't it, by...
Well, yeah, you've just mentioned HSBC, so I think they've literally, I've just been on their website, and you're right, that's changed since yesterday. So I suspect that they're changing as they go along.
Yeah.
So
I'm literally on there now, so I'm going to play on there now and just see what happens.
Okay, good luck, Darren. I think Mark Exley, I think that link that Charles just beat me to sharing gives you the listed accredited lenders at the moment. Barrett, did you want to ask your question of James?
Yeah, I mean, if you don't actually need the money right now, is it worth applying so that you've got the, I mean, it's cheap money. So I was just wondering whether it's worth getting the money forward.
Right, well, there's an official answer and an unofficial answer here, Barrett, for this one. The official answer is this is an emergency loan scheme, which has been designed to help businesses who have struggled or suffered as an impact of COVID-19. And you do tick a box to say that. Now, inevitably, when you start talking about lending money with low due diligence, with no personal guarantees at low interest rates, there are people who are going to be attracted to that, even if they don't necessarily need the money. The spirit of the scheme has been brought out to help people, businesses who are struggling and need the cash. The reality is that if you are eligible to apply and you think you may benefit from having this money in the future, you'd be crazy not to at least consider it, because you're never going to get cheaper, quicker money again than this. And if all else fails, you can repay it within 12 months without paying a penalty in interest.
Right.
So, you know, each business is different. A majority of businesses who apply, I think, will be ones who genuinely need the money to survive. If you think you might need the money in a year's time because you're thinking of investing in certain things at that stage, and you're happy to have it sat in a bank account for a year, is there anything to stop you doing that? No. Is it in the spirit of the scheme? Probably not. But ultimately, as long as you repay it.
Yeah, I think my point is that really we don't know how long this is all going to go on for, and quantifiably what impact it's going to have on our businesses. So, you know, if there's an opportunity and you can get in at the ground floor, then what I'm thinking about in the interest of the business is actually preparing for the eventualities. And yes, it is within the spirit in that respect, because you're obviously trying to safeguard.
I'm not judging anything. I'm just saying.
No, I understand.
You know, this scheme has been rolled out initially till the 4th of November. It's important to know that as well. So it is a scheme that's been out for 6 months. So you don't have to apply ASAP, and there'll be government discretion with regard to extending that as well, which I wouldn't be too shocked if it's extended pretty much indefinitely. And if you take it out now, then your year's worth of interest and capital repayment starts straight away. If you take it out in October, your year starts then. So to answer your question, honestly, will it be useful and cheap money to have? Absolutely. Is it worth applying before you actually need it? Probably not, or as close as possible to the end of the loan scheme's actual timing, so November the 4th. No, because then you start losing your capital repayment holiday straight away. So you might as well wait as long as possible.
Right, thank you.
Hey, any more questions for James?
Yeah, it's just one, James. You're saying it's 25% of turnover.
Yes.
If you wait until you need it in October or whatever, is it the last full year of turnover, or? Okay,
so it's a self-certified position, Phil. So I've taken the view on this that a degree of flexibility is absolutely fine, because at the moment a lot of people's turnover is zero, obviously. So I personally think you should be basing this, and there is no set rule, basing it on the last 12 months of turnover prior to COVID-19.
Yeah, makes sense. Thank you.
Because a lot of people will base it on their last trading figures. I don't necessarily think that's accurate, because they can be several months out of date. But I think if you work on the last 12 months of trading, actual trading, I think that's more than fair.
Okay, Dashik, you have a question for James?
Yes, so I think you've already touched on this, James, and that is, other lenders, can the lenders coerce you into buying one of their current accounts or business current accounts as a condition for approving the loan? And the second one is, if your application is successful, what's the sort of expected or anticipated turnaround time before the funds actually get paid out?
So can they force you to take out a current account? Absolutely not. But obviously, as I mentioned earlier, bearing in mind that the 3 biggest lenders in the country are only accepting applications from their existing clients at this moment in time. HSBC's process, as the only high street bank who really are accepting applications from non-customers, is that they're not asking you to take out a current account. I don't really think they want the hassle of that, to be perfectly honest. So no, there is no obligation to take out an account with whoever you take the finance from. How long does it take? Well, that's what we're working on at this moment in time. So Barclays have paid out 6,000 already, so they've pretty much got an instant process. The NatWest process seems to be taking longer, as does HSBC's. And that's why I kind of said we need to have ended the first week before we can really answer that fully, because we don't know, because not enough have actually been paid out at the moment, does it, to be honest. So it seems that some people are paid out pretty much immediately. Other people, we're sitting and waiting how long it will take. I would imagine once you've had an approval and you've completed the documents electronically, then it will be a pretty much instantaneous transfer of funds. So I would imagine the average turnaround time will be about 48 hours. But at the moment, that's the best guess because this is just so new.
Okay, thank you.
Margot, were you waving at the camera earlier?
Yeah, you said something like you said, I think you said something like you can transfer a Sybil's loan onto your bounce back. Why would you do that?
That's a great question. So you can transfer a Sybil's loan to a bounce back loan as long as the loan is under £50,000. The only reason I can think of to transfer from a Sybil's loan to a bounce back loan is because the interest rate will be cheaper. Because the Sybil's loan scheme, and forgive me, I know you came in a bit late, Margot, the Sybil's loan interest rates are set by the bank. So it's anything from, I think it's at 3.5% to the lowest I've seen, and 20% is the highest, while the bounce back loan is at a fixed interest rate of 2.5%. So if you had a Sybil's loan agreed for £40,000 at 20%, you might feel that's attractive to now move that to a bounce back loan for 2.5%. That's the only real reason I can think of, because everything else in the scheme is pretty much exactly the same. Yes, the guarantee is higher for the bounce back loan, but that's for the lender, not for the client. So that's the only benefit, obvious benefit I can see of switching across to a bounce back loan.
Okay. Okay.
Thanks, James. Nick, were you waving at the camera?
Yeah. Doesn't the CBIL loan, even though it's 80%, it's only 80% backed by the government. So I'm assuming that this is potentially a bit like a EFG type loan. So won't the directors potentially be liable on any residual debt, whereas on the bounce back loan they aren't personally liable? It's only the company. So there is another benefit, personally liable for doing a bounce back loan.
The only Sybil's loans under 250 grand have no personal guarantees on them at all. So if you've got a Sybil's loan above 250, it's a discretion thing between you and the bank to decide. Right. If it's below 250, there's no personal guarantees, and there's no personal guarantees on bounce back loans at all. So the borrower, i.e. the company, is always liable for the debt, no matter if it's a bounce back loan or a Sybil's loan. The director's personal guarantee, it does not apply for any small Sybil's loan under 250 or any bounce back loan over 250. It seems to vary, to be perfectly honest, bank to bank.
Okay, thanks, James.
And looking at your question there, so there's a couple of questions that popped up, one from Nick, one from Russ. I'll answer them. The due diligence, yeah, absolutely. It's basically a very, very quick credit search, and that's it. And that's, have you got CCJs? If you haven't got CCJs or defaults, then you're going to pass that search. There's simply not enough time, and Nick will know this from his background, to do any due diligence. There's no time for it. And that's why the 100% guarantee from the government was needed, because the banks recognise, well, it's recognised that they won't be able to do any due diligence, so they have to just basically take a flyer on it. And with regard to self-certification, yes, you have to confirm you weren't an undertaking in difficulty on December the 31st, 2019. So basically, what that actually means is, were you insolvent? Were you loss making? Were you thinking of winding a business up? At the end of 2019, if you were, then you're probably going to say you were an undertaking in difficulty. But again, it's self-certification. You literally tick a box to say, were you in difficulty or not? And yes, and Russ has mentioned that, confirm you weren't insolvent. Yeah, the term is undertaking in difficulty. So you have to confirm that. But again, it's self-cert. So who's going to say they were at the end of the day, realistically?
Well, there was actually a typo on the form. It asked me to make sure I wasn't insolvent in 2919.
2919.
So some way off.
Yeah.
I'm assuming that has no legal ramifications at the end of the day.
Okay,
so you probably won't care, Russ, when the back day comes round, I imagine. Right, the few hands up. Barrett, do you want to ask your question as soon as you typed it in the chat? Then I'll get to Mark and Margot.
Yeah, just to follow up on the previous comments that James was making, and that is that if the liability is with the company and for some reason the company fails, does that liability then die with the company?
Yeah, if the limited company is, now clearly someone like Nick's involved in the solvency, so it depends on the assets of the company and all that sort of stuff. But,
yeah, sure.
But yes, but for you on a personal level, yes, if the company is wound up and the company is liquidated, then the liability to the bank, well, the liability for the company dies at that stage, and that's at the stage where the lender will then go to the government to get their guaranteed money back. So the taxpayer is ultimately going to foot the bill in that case.
Yeah. Okay.
Okay, Mark.
Yeah, just to clarify, is it the case then that if you take, say if I took the loan in October, do I then have a year of what happens in that first year? Are the repayments paid by the government effectively, or is it just the interest?
So the interest and repayments are paid by the government in the first year.
So that comes off the loan then. What I'm saying is, if I borrowed 20,000, the loan will diminish.
No. If you borrowed, let's say, £20,000, well. Then this is where terminology is important, isn't it? So effectively, the way the system has been done is, if you borrow £20,000 and you borrow it over a 6-year period, so you have your 1 year of capital and interest covered, and then you have a £20,000, and then you have 5 years of capital repayment. I understand what you're saying. They actually defer it, so you're still going to pay £20,000 back. It's just what would be perceived to be the repayments of the first year are actually paid for you.
So effectively, after year one, you still have 20,000 borrowed, and the interest rate would be 2.5%.
Yes, that's
correct. That's annual, I presume.
Yeah. That's 2.5% of the reducing loan balance. So
right.
500 quid the first year, and then whatever it is.
Yeah, dropping throughout the term. Yeah.
It's very, very cheap money, honestly.
Yeah. No.
Thank you, Margot. Did you have another question?
Yeah, I mean, I've got enough cash flow to keep me going for sort of 4 to 5 months. So if I sort of in 6 months' time decided I wanted a bit of a loan, because my husband's business is ground to a halt for the time being, so the turnover is just going to be mine. It's going to be a lot less, an awful lot less than it normally is. So how do I self-certify then? Because
But I answered this one a minute ago.
Oh, did you?
Bill,
I'm sorry. Apologies.
You were probably asleep, Margot.
No. But you answered. No. But you answered. I thought you answered for somebody who's taking out a loan straight away. I'm talking about deferring a loan.
Well, no. The answer I get, I'll repeat it, is you self-certify your turnover and you literally type it in. And I think it's fair to say that turnover you input there to say is your turnover, which the amount you can borrow will be based on that. The last 12 months of turnover before COVID-19, I think will be more than fair as a figure to put in there. So up to, let's just say, the end of February 2020, the 12 months prior to that, I think if you base your turnover on those figures, that's more than reasonable.
Okay. And then Dashik's made a comment. Dashik, do you want to ask James your question?
Yeah, sure. Thank you. Well, this is, I don't know if it's relevant to the topic under discussion, but I was watching the Martin Lewis Money Show last week, and he happened to say that there might be some announcement or a plan for people who work as single director employee sort of companies, so essentially contractors and freelancers, which is essentially my background. And so far, contractors have not been part of the government's rescue packages. I just wonder whether the BBL is that package, or whether there is potentially something else specifically lined up for the freelancer market.
Okay, so again, the expert on this will be Mark Exley in the room, but what Dysic's referring to is the fact that as a sole director of a limited company, which probably, I know you say it certainly applies to me, and I'd imagine it applies to at least 3 or 4 other people in this particular room, we're not eligible to apply for the self-employed maximum £2,500 per month. We can furlough ourselves, but who the hell wants to furlough themselves for 500 quid a month when we actually need to market our business? So a lot of sole director limited companies, I think there's around about 1 million of us, who feel sort of missed out, if you like. And yes, I saw the article you're referring to. I didn't see it on Martin Lewis, but a couple of MPs have taken this forward, and there was talk of a similar kind of rescue package, if you like, for want of a better term, being put forward towards single director limited companies. To answer the question you've asked, no, that's not the BBL. It's completely different. This is a scheme designed to save the business, not to save the individuals behind the business. Okay. I don't know if Mark's got anything he wants to add, if he knows any more about that.
I think that the primary, it's a bit of a double-edged sword, because the furloughing thing is one issue, but because of the money is going to be quite small if you furlough yourself. The main consideration is that once furloughed, you cannot work on the business. Whereas what they've effectively done, and I think it was a knee-jerk reaction, is they've allowed self-employed people to not only get up to this 2,500 a month, but also carry on trading. So where you've got a self-employed person who's, say, their partner's also self-employed, although doesn't do any work, so they can split the proceeds between them. They can both get a £2,500 grant per month, and they may be working very hard and with lots of work on. They're allowed to work. So it's they've got it massively wrong in relation to owner directors, and it's not that's the first point. The second point is that where you've got an owner director or 2 owner directors who then employ people, you're not only jeopardizing the owner directors' livelihoods, but you're also jeopardizing the business that employs people. And there's 13.2 million people employed by small businesses, which is a catastrophe waiting to happen. And I think they're recognising that, and that's one of the reasons why we've got this bounce back loan situation, because I think they've realised that they've shot themselves in the foot. Because the self-employed sector is important, but it's actually small in comparison to the potential impact from small businesses that are actually generating wealth by employing people as well.
Yeah, I couldn't agree. I couldn't agree more with that, and I think it's important to realise with the bounce back loan, it's definitely focused at limited companies, because as I mentioned earlier, the borrower remains liable for the debt. So if you're a sole trader or a partnership, you're the borrower. So this is definitely aimed at limited companies who wouldn't have to sign personal guarantees, rather than sole traders and partnerships who are benefiting from other government support that Mark's alluded to there.
Okay, thank you.